Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to a special edition of Charts and Chat for December 24th of 2023. Well, I hope all of you have had a wonderful holiday season, and we are all certainly looking forward to 2024 after what has been a surprisingly positive 2023, all things considered. Obviously, there's puts and takes in any particular year, and entering 2023, we kind of thought we were going to have a more pronounced slowdown, and we were going to have perhaps a light recession. That has not transpired, even though we have had some slowdown in some certain areas. Inflation was definitely the theme that we were all watching throughout the year, and I have this as my opening chart right here. And really, as we close out the year, I want to kind of give you some thoughts that I have heading into the new year, some observations, kind of like speaking through a series of charts as I do every week, but kind of pulling out some charts that that I paid a little bit more attention to, that I think charts that we're going to be talking about a little bit more as we head into 2024. And obviously this one being inflation. This is the consumer price index. We're going to start off with a few charts on inflation, kind of get into some of the other areas that I think are important for us to consider, and then we'll get into a whole series of investment related charts that I think are going to be themes that we're going to be echoing again and again here, at least in the early part of next year. But let's look at the most recent data here in inflation. So in the amber line, that's the core CPI that remains at a higher level than the Fed would certainly want it. That's 4%. That's in the amber line. The blue line represents the headline CPI, and that came in at 3.1. You can see the general trajectory of these right here as we had the hyperinflation coming out of the pandemic, and then it's been easing down, and we can see here that the core CPI has been a little bit more sluggish in its downtick than has the headline CPI, and we've actually had a little bit of an uptick in overall headline CPI, but the overall trend is down. We think that's certainly going to continue. I'm not so worried about the pace of inflation as I am about monetary policy and making sure that we don't overshoot. There have been notable cases where the Fed has, has begun to, lower rates in response to what they feel was a pretty benign inflation environment, only to see inflation reaccelerate. And that's what we don't want to have. And the market's gotten extremely exuberant about having, perhaps 6 or maybe even 7 rate cuts next year. And I just think that's a fool's game right now, and I'm not buying into that rhetoric just yet. On this slide, we have kind of a breakdown of the components of the CPI. You can see the trend line here. As we look over at the far right, you can see that the pronounced inflation that we had, and it's kind of giving way to a general downtrend. You can see, the amber components here represent shelter. Shelter does remain sticky, although you could argue that rents, which is a component, certainly a component of shelter, calculated differently, the observed rents are actually negative right now, but overall owner's equivalent rent as defined by shelter, which is a meaningful, say, almost 40% of the core CPI, and about 30 to 33% of the overall CPI. It's still an albatross around our neck. And say you look at energy's been a bit of a tailwind lately, which has certainly been a positive, and we've got other headline issues that are still at bay, but overall the trend is down, even though we have points within there that are still relatively sticky. Another look here at core CPI. You can see the general trajectory is down. A lot of people are kind of looking at these other measures of inflation, like the super core, where you're backing out other things like shelter. Shelter, as I just mentioned in the last slide, is an important part of core CPI. I don't think you can discount it. I'm not saying it's not a valid statistics or valid data point that you should be monitoring, because Supercore actually has gone up. Inflation by that measure has actually gone up over the last couple of months. But I do think there a lot of this does matter. Core CPI is really the things that are most germane to what people buy in their average daily routine. It doesn't include food, it doesn't include energy. We know that we've seen deceleration or disinflation in both of those components, which is absolutely positive. And we're also seeing disinflation in overall core CPI as well. Now, to be clear, that can be misleading if you're not thinking about it the right way. This doesn't mean, even though we've had this deceleration, that doesn't mean that we're having negative inflation, that we're having deflation. It just means that we still have inflation, but the rate of change is going down. Here we have another look at core inflation. You've got core CPI, the Consumer Price Index, core PCE, which is kind of the Fed's preferred measure of looking at inflation. That typically runs a little bit lower. And so you can see that in the amber line, consistently lower in most of these readings with the exception of here. But you can see that we kind of troughed out in May through June, July, and then we had a little bit of reacceleration in just core CPI at a time where the PCE was still pretty low. September, it looks like, is kind of representing an aberration. We had different things that were going on at that point. And so we just see this little downtrend here in core PCE. So this is what the Fed is looking at right now. And so, if you look over the last 3 months, this is relatively impactful, right? Because you've got a 3-month annualized rate of change that's actually a lot closer to 2%, which is where they want it. Now, it has to be habit forming, so we need to see this type of downticks persist, even though the core CPI number as of the last reading was around 4%. One more look here at core PCE prices, this time on a quarter-over-quarter basis. You can see the bubble that we've been talking about following the pandemic, and we did have a price deceleration at the core PCE level, around the time of the pandemic. And so you can clearly see that number on a quarterly basis, again, the 3-month rate of change here, settling right around 2%. One more chart here before we leave the inflation topic. This is a little bit more of a global view, which I think is really impactful and informative here. You've got sequential core inflation for companies that really, just like the U.S. exhibited or experienced a surge in inflation. And you can see, a fairly static line of inflation here until we get to this highly disruptive pandemic period. Then you saw that hyperinflation related to supply chain issues, and you can see that that's coming down at a fairly strong clip. So again, just to point out the fact that this is not just a U.S. thing that we're talking about with regard to inflation, but it's a very strong global impulse. In fact, getting back down to levels that we were accustomed to for many, many years beforehand. So the two things that tend to be really sticky when we talk about inflation, kind of transitioning away from like in the inflation number itself and kind of looking more into the components is, the two things that are sticky are wages and rents. And this is real hourly, average hourly earnings on a year-over-year basis. And you can see here in this chart that we've had 7 straight positive months of real wage growth. Following a very prolonged period and somewhat unusual period of negative wage growth. And so, purchasing power has certainly expanded here. Wages are relatively sticky. This gives people a feeling of having purchasing power. This helps to kind of extend the duration of the consumer spending that we've been seeing. And arguably, consumer spending is what really kept us out of a more material downturn this year. Obviously, we'll have to wait and see if it continues in 2024. But clearly, this type of development is very positive for the consumer, very positive for consumer spending and retail sales. Now we're going to take a look at kind of an overlay of both leading economic indicators as well as year-over-year change in real GDP. And so these things tend to follow each other to some degree. LEI, by its name, would tend to foreshadow changes in real GDP. And you can see here in the blue line, which represents the LEI, that we have been down for 20 straight months now. So we're basically pushing 2 years of consecutive declines in the LEI. Even though the declines have kind of attenuated somewhat, they're still in the negative. And so you can see here in these periods that are, that have these gray bars for reflecting recessionary periods, this is what people have been talking about very consistently that are more bears on the market, saying, listen, this number has rarely, or in some cases never, been associated with a non-recessionary environment. So, but we're not talking about recession right now. We're talking about a soft landing, but an economy that does have some risks. And so I think this does have some informative power when we talk about the change in LEI. But here we have a little bit of a reacceleration in GDP. And so, this is a bit of a disconnect right here. And I think, you will begin to see, after probably the first half of 2024, and unless, there's new things or new information that comes about, this number is likely to remain sluggish, but then tail back up again. And then we do see, overall GDP growth kind of like flattening out at a low point before it too begins to reaccelerate a little bit. Now, thinking about economic growth on a little bit of a longer term, I offer this slide to you. So this goes back to 2001. So this shows everything through this current 21st century. And you can see the trend line growth is about 2%. That's in that little dotted line right there. You can see that we kind of fell below that during the global financial crisis and really struggled to catch back up. And ironically, we had essentially caught up with that trend line by the time the pandemic happened. And you can see that we've kind of pushed up against that line right now. So this is the trend line that we're gravitating towards. And, before the global financial crisis, we were accelerating a little bit faster. And then, we had to do some catching up. But, if we think about overall growth, 2%, 2.5% is probably something to aspire to, but it might be a little bit closer to the lower end of that range for the next couple of years. Here we have something that I do think we're going to be talking about over the next several years. This is a kind of a chart showing U.S. government debt service. This is interest as a percent of total government revenues. And, in a fairly dramatic turn, we're expected to see this acceleration by the time we get to 2033. What are the implications of this? I think, government spending, which is part of that C plus I plus G plus X equation to get to your overall economic growth. So you've got consumer spending, you have net investment, you have net trade, and you have government spending. And that G in that formula is going to be impacted by this. This is essentially crowding out government spending by virtue of an increase in the percent of overall revenue that's having to be spent on interest outlays. And so it will have an impact, I believe, on overall economic growth unless we, change the equation and reverse our massive deficit spending on an annual basis and get this thing turned around. So we'll pivot here and talk about labor for a second. You can see in this chart from BlackRock, really that we have had monthly changes in payroll that have decelerated. This is symptomatic of a slowing economy, even though I'd say the labor market remains fairly strong. Just as this kind of subheader implies that we are digging ourselves out of a relatively strong payroll deficit that was created by that pandemic, and we haven't really caught up with that trend line for expansion, and so the question is, are we going to get there because of a slow labor market? But overall, the labor market does remain strong. Of Quick look here at jobless claims. You can see, this number is still not consistent with what you'd expect in a recession. Again, owing to the observation that the labor market is certainly stronger than I think some people thought it would be by this time. There were forecasts this time last year of an unemployment rate that was closer to 4.5%, and we're absolutely not at that point right now. In fact, jobless claims, look like they're probably trending down, if anything else, which is a symptom of a really strong economy, which should help to continue to support wages that we looked at a few slides ago. For a quick comment on the consumer here, this is personal savings as a percent of disposable income. Basically call it generically a savings rate. And you can see here that for a long time before we got to the pandemic, that was about 6%. And then we got a lot of stimulus checks, a lot of transfer payments from the government that went up quite a bit. And then we've consistently been spending that down. And so, interestingly enough, beginning of the year, we did have a little bit of an uptick in the savings rate, but that is now trending down. As we're seeing the consumer support their spending habits through an erosion of their personal savings. You'll see, here coming up that there's also been an acceleration in the use of credit cards. So not only are they burning their own seed corn, but they're also borrowing more to help sustain their spending habit. And I think as we look into 2024, this is something that we're going to really want to pay attention to. Now, there's another chart that lives out there, data that lives out there about excess savings. And so, this is a percentage number, but the excess savings number has been thought of in terms of its aggregate level. And at one point, with all of these transfer payments, that number was around $2 trillion. And now, with all of this spending down, that we're probably somewhere closer to about 500 billion dollars, if you will. And so, that's a quarter of where we were, but it's continuing to go down every month. And so the big question heading into 2024 is how well can the consumer sustain the economy when they did such a great job of it in 2023? So another thing that we want to pay attention to with regard to the consumer heading into 2024 is credit quality. And we do know, as we've just shown you, that savings rates are moving down, so consumers are sustaining their spending habits by drawing their savings down and increasing their credit card debt. And when you have a slowing in the economy, or when you get consumers that get a little bit stretched too far, you get what we see here. And these are defaults that are on the rise. And in fact, we're at a record level, in data that goes back to 1991. Interest on that debt we know is going up. So, credit card interest rates are now migrating closer to 24% in a lot of cases. And some people are just saying, listen, I can't do that. And so you see these defaults. And so, these are things that you want to monitor. Credit quality on a whole host of assets is going to be really important to monitor next year, whether it's mortgage defaults, whether it's credit card defaults, which we're looking at here. Certainly on the commercial side, there's a lot to talk about there. But, this is something that doesn't seem to be at a crisis level now, but it's something that we're going to want to monitor, especially when you consider that there's a lot of student loan debt that is out of abeyance now. And so, the average student has got somewhere, or the average postgraduate, I should say, or maybe even non-graduates in a lot of cases, are going to have like anywhere between $150 and $200 of extra debt related to student loans. And you could argue that, that there are some things that are going to get left behind. And I think that these are all going to be important things for us to want to pay attention to. In this chart, we have the New York Fed Consumer Expectations Survey. You've got two different data series here. You have the household financial situation, people that are responding, saying that they're much worse off than a year ago. That's in the blue line here. And so you can see that this number had been going down, but then it's picked back up. Again, when you have a little bit of a slowing economy, you'd expect that number to move higher. Obviously, that's higher than we've seen it in quite some time, with the exception of the spike that we had last year when the markets were really in tough shape. And the amber line here, household situation, much better off. And so you can see that that number is it's flat to down. And so very consistent in data that goes back to 2013. It shows you when you have a slowing in the economy and more rhetoric about that slowing, that your consumer expectations are going to be impacted as well. We have a quick note on housing here. Housing has obviously been challenged. I've got a follow-up chart coming up after this, which is very interesting. But existing home sales, we know, have been trending down. Higher interest rates. The average 30-year fixed mortgage rate is about 6.7 now, so that is down from its peak, well over a percentage point. And so you can see here on this chart that we actually did have a slight uptick in existing home sales last month with the decline in interest rates. We did have had a little bit of an uptick here now in existing home prices on a 12-month rolling basis. And down here, what's interesting is that you're seeing both housing starts and permits now positive again year over year. And so, while this is pretty painful on the existing home sale number decline, and that we saw a massive deceleration of home prices for quite a while, and actually went negative for a brief period of time, that these kind of show a little bit of settling out in the housing market overall heading into 2024. Here we have that related chart that I thought was very interesting. So when you're not selling as many houses, you don't have as much turnover, you don't have as much remodeling. People are kind of like sit in place, and they're comfortable. They're not spending nearly as much at furniture stores and home improvement stores. And you can see that those numbers, 2023, are negative. You can also see employment in these particular industries have been particularly weak. Electronics, retailers, home improvement, and furniture. Now we are going to switch to the commercial sector and take a look at Chief Financial Officer surveys. This is an optimism index put together by the Richmond Fed as well as Duke University. So you have optimism about the U.S. economy in general in the blue line. And you can see that that optimism is actually picking up a little bit and has for a number of months. At the same time, optimism about their own company seems to be flagging a bit and maybe even tailing slightly down. So this has a lot of implications, when CFOs and executives are not feeling as confident about their own prospects. They're going to curb their spending. They're going to want to manage their expenses. They're going to obviously manage headcount, probably not going to hire as many people. And this type of sentiment, when they're telling you that they're feeling this way about their own company, tends to help perpetuate like a down cycle. So heading into 24, we expect things to slow down in the first half before perhaps reaccelerating in the second half on the basis of interest rate cuts. I think this is very consistent with the thought that you're going to have a softer environment. And I think, the current consensus is it's going to be a soft landing. You're not going to go negative, that there's so much caution out there right now. Even though overall optimism remains pretty high relative to some of these other periods, the environment is not going to be, certainly not going to be catastrophic. We talked about credit a little bit earlier, and this is a credit on the commercial side and for commercial and industrial loans, C&I loans. And this is all part of that whole credit conversation about what we're going to be focusing on heading into 2024. And so credit is pretty tight right now, maybe eased up slightly, but when you look at it on a trend line basis, it's pretty high, and it's typically, it gets high when you get close to recession periods here and here and here. And so, again, going back to the question, are we going to have a recession? Honestly, the pundits don't think so, but I do think that we're going to have a slowing down because you don't have that generally, and you don't have a leading index of leading economic indicators that's down for 20 straight months without some type of measurable slowness beyond what we've already experienced. Now, this is something I've been talking about for a long time now. It's a non-bank banking sector. And so we just got through looking at a chart of credit standards tightening on the part of domestic commercial banks, which the Fed monitors. But this is the non-banking sector. This is, private credit. These are, private funds that are lending money at higher interest rates. And you can see how this has completely gone through the roof. And again, as this chart indicates, we're talking about 65 trillion in hidden debt from this non-banking sector. And so this is where people that can't get loans from the commercial banking sector are more likely to go. On this chart, we have commercial mortgage-backed security loan delinquencies, just as we saw with the consumer sector. On the commercial side, we're actually seeing a noticeable uptick in delinquencies as well. Here we have commercial real estate debt maturities. This is kind of the debt bubble that we've talked about at various points over the last 6 months. As we saw these interest rates moving higher, maybe interest rates are off their highs, but there's still an issue that we're going to have to face. So we've got basically here almost $660 billion of commercial real estate debt maturities that will come due or have to be rolled over next year. And then we've got another $540 billion that'll be coming due in 2025. And you can see the various breakdown here that, office, represents about 117 billion. We think that's probably going to have the most stress. You've got apartments up here, and then, obviously retail, lodging, et cetera, in this category. But over the next 2 years, when you think about it, you've got to roll your debt. That is going to be at a much higher interest rate than was previously the case. And particularly, when you're talking about office, that reset may be catastrophic because a lot of these buildings are showing much higher vacancy levels. And of course, cap rates have moved higher, so valuations have moved lower. And so you get loan to value kind of considerations. And it's going to be something that the whole institutional investor community is going to have to work through, because there's a lot of pension plans, there's a lot of insurance companies that own a lot of real estate that have that leverage to, in a normal market, use leverage to help juice your returns. In this case, we'll have to see how well those borrowers are able to weather the credit crunch here. This chart, we have Philly Fed data as probably the most recent data that we have from a regional Federal Reserve bank. And you can see here the Philly Fed, we're down at negative 7.5. This is a forecast for capital expenditures. And so, going back to that CFO survey that we just talked about, their spending intentions have gone down because, by and large, I think they're a little bit more cautious about the outlook. And just, quick word here on the Philly Fed survey. Again, it's just one of the 12 Federal Reserve banks represented here, but it is kind of a general proxy across the country. So the index itself last month was down negative 10.5 versus a negative 3% estimate. So it's worse than expected. And it's worse than the prior reading back in October. New orders were down, prices paid were up, and this good news here, the silver lining in all of this is that the 6-month outlook has certainly improved. So this is good news, but it kind of corroborates this theory that the next 6 months is going to be a little bit soft. Here we have more data from the Philly Fed. So this is the business outlook survey. So this is basically the general conditions assessment. And as I mentioned, the overall index was down 10.5% previously. And so where we are now is just kind of at a softer, kind of a level that's kind of consistent with a soft landing here. Now we're going to transition into the investment markets for the majority of the rest of the charts here. And so first thing is first, and that is volatility is very low. I mean, we're like 12 on the VIX. And we haven't seen that since January 2020. And you all remember that that was a month before we really started getting, the issues, coming to the front about the pandemic. So volatility is very low heading into 2024. Complacency is high, confidence is high, and just want to guard against what former Fed Chair Greenspan used to call irrational exuberance. We've got a chart from Fidelity on valuations and earnings. You see the black line here represents the S&P 500. By and large, from that October 22 low, we've had a pretty good run, and we've had some good runs. And obviously the market point to point is moving higher, but we've had a particular breakout aided by these Magnificent Seven stocks, if you will. But we actually, over the course of the last 2 months, have witnessed a broadening out in the economy, which I think is a theme that will continue to play out here in the next year. But down here in these shaded areas, it just represents areas where we've had earnings expansion. And so we saw a lot of earnings expansion. 2021, that's actually gone negative. We see earnings that are still relatively high and expectations are high, but they've come off their peaks. But at the same time, when we've watched this overall rally, with the exception of this little downtick here, but this overall point-to-point rally has been driven largely by valuations. And we see valuations moving higher to a point where, you could almost argue that we're in a bit of an overbought situation, that maybe we're due for a pause or a little bit of maybe a little modest sell-off or whatnot. But the overall trend line is certainly positive. Quick note on the Magnificent Seven. This is really not a direct overlap, but it's the overall technology sector. And this is something that I think is really interesting. And, we used to talk a lot about, those of us that were active in the markets back in the tech bubble in 2000. Now, we saw a spike here, which is an all-time high, somewhere close to about 34% of the overall market. We're not quite there yet, but at 32-ish, we're very close. And we've seen over a number of years the technology sector just really assert itself in terms of leadership of the overall market. But by its nature, when you have something that happens like this, it just makes the overall index a lot more volatile. We have some data from FS Investments, and Laura Rain, their chief economist, chief U.S. strategist, is very good on what she does, and so a shout out to her work on this. But she put together kind of like her 10 points of observation heading into the new year, and I kind of excerpt a couple here because they really dovetail with what I'm thinking. And so the concentration of market capitalization here, this is the top 10 stocks in the S&P 500 index. And just like I showed you in that technology sector concentration chart on the last slide, we're now 33 to 35% concentration. And again, it just makes the whole S&P 500 a lot more volatile. And so, one thing I think is going to be a theme that is already beginning to play out here. The last month or so, we've had the equal weight index pick up some steam. Now it lagged considerably the all-in index because of the concentration factor here. But we've seen broadening out in overall performance, and I think that has something to do with this over here. And so the Magnificent Seven annual free cash flow growth was well in excess of the overall S&P. And overall S&P 500 is doing fairly well on cash generation, but at the same time that the Magnificent Seven is witnessing a deceleration. And some of that has to do with the law of large numbers. When you get so big and you're growing so fast, that over time you just naturally begin to witness lower overall growth rates. And I think if this continues to play out over the next several years, you're going to see a market that's going to be a lot more healthy. It's going to be, a lot more broad-based. So it's not going to necessarily be led as it was this year by the Magnificent Seven, but it's going to be a bit more egalitarian from a contribution standpoint. Here's something else that I think is really interesting to talk about, and it's sector rotation between value and growth and small and large cap. And this is from Fidelity, and Urian Timmer does a great job here. He just breaks us out into decades when you've had these sector rotations where you had an uptick in, whether it be, small versus large, and then you have a reversal. Then the other side takes control. And so small versus large, 10-year compounded average growth rate, value versus growth, also on a 10-year compounded annual growth rate. You've got a commodity index, 10 years, and then you've got non-U.S. versus U.S., basically international stocks versus U.S. stocks here. And in each case, you see a lot of convergence on these particular things, and they don't always look the same. But what we've had here, basically looking out over the last decade, is you have had large company growth really outperform. You've had growth that is outperformed. You've had commodities in here that have actually gone down at the same time that growth stocks have accelerated. And that all seems to be kind of changing. That leadership paradigm seems to be evolving into what Timmer describes as kind of like this next 3-decade transition process. And so, if you believe in that, if you buy into that, then you're expecting better performance out of value. You're betting on better performance out of small caps, which are trading at a huge discount to large caps, and you're also betting on international, which is trading also at a huge discount to U.S. large caps. Here we have a quick look at S&P 500 revenue in the black line. You can see the dotted line represents a forecast. So, we're looking at revenue forecast or revenue growth of roughly about 5%. Middle market a little bit higher than that. This chart again from FS Investments, and they do a lot of lending into the middle market through some of their funds. And so, this has kind of a double-sided viewpoint that there's attractiveness in the areas that lay outside of the publicly traded markets, in some of these private capital markets, which I'm going to kind of touch on here towards the end of the slide deck. But when you feel like 5% revenue growth is is certainly in line with what we've seen in the past. In fact, we've seen lower growth in sales. Now this is sales, not profit. So profit, we've seen margin expansion through this particular time frame from 2012 on, and so you see earnings moving like that because you're getting additional leverage. But it is very interesting to see that the middle market here, the expectations are for maybe a deceleration in revenue growth, but overall growth that's above that which you can find in the public markets. Here you have earnings breadth, so what this tells you is that we're seeing a little bit, we've seen a trough here and an uptick in earnings breadth. And if this continues with the S&P 500 overlaid, when you get these troughs, you see a little bit of turbulence in the market, and then it goes back up when you have positive growth. And then when you have, breadth that declines, and you have more turbulence, and then so on and so forth. And so if this is an inflection point, it's going to continue to move higher in terms of earning breadth, and that would tend to lead you to believe that the S&P 500 has some staying power on its upward ascent. So just like I was talking about the commercial real estate sector and having to roll over debt maturities, over the coming years, the same really holds true for the S&P 500 companies, as well as the U.S. Treasury is going to have to roll a lot of debt over the next 12 months. And you can see here on this side, this we've got about $550 billion of debt for the S&P 500, which represents about 8% of the overall debt stock of the S&P 500. So about basically 8% of the overall debt held by the S&P 500 is going to have to be rolled next year. And we know that that's going to be at higher rates. And that actually gets more acute, not only over 25, 26, but when you look over the next 4 years that come after 2024, you've got a lot of debt maturities here. Of course, we don't know what interest rates are going to be, when we get out into these out years, but, if it moves, entering 24, we know it's higher. And so this is something that we're just going to have to monitor. Now, the S&P 500 as a whole, really, their balance sheets are in pretty good shape. Now, the flip side of this is that they're also earning a lot more on interest. And so we just looked at that cash flow, some cash flow data, and that cash flow data is pretty strong. So, they're generating cash, they're investing at higher rates. So even though they've got these debt maturities that they're going to have to roll over, that they're still in a good situation. Now, on the flip side, we've got Treasury debt maturing over the next 12 months, and that is, we're looking at like $9.5 trillion here. And so that's pretty profound. And so we looked at that earlier chart about the net interest expense burden on our government. And, this is profound. I mean, the average interest rate on U.S. Treasuries was somewhere around, like 2.1, and that's going to move materially higher. And so the chart that I showed you earlier about the interest burden on our federal government, that's a real thing. Got a few slides from Wisdom Tree that I thought were pretty interesting. This one basically, is making the case for a new moniker. First there was TINA, which is there is no alternative to U.S. stocks because we saw interest rates at or near zero. Well, now that's obviously changed, and so we saw a real big spike up to like 5.5. Now we know interest rates are coming off a little bit at the short term, but now they refer to TAMI. There are money market yields, and so that is a nice alternative over stock dividend yields, which have moved down with the market moving higher. And so even though inflation's taking out about 4% of that 5.5 from a real standpoint, you do have an alternative investment class now if you're looking for more conservative type growth numbers. We have a chart again from Wisdom Tree showing the relative outperformance of large cap stocks. And just as I told you, or I showed you on that Fidelity chart a few charts ago, we might be at an inflection point where small caps are going to take a little bit more of a leading position here in the coming years. Now we look at mega caps versus bonds, and this has been a pretty easy argument over the last handful of years. You look at where we are now, there's a pretty strong differential. I mean, if you'd had no bonds, you would have had a lot more volatility, but you would clearly have done well in the markets. And again, now these things tend to mean revert over time, but just the observation here is that mega caps have certainly done very, very well relative to the entire alternative case. We have a sea change actually of sentiment on the part of active manager equity exposure, and literally just about a month and a half ago we were at really low levels of equity exposure, and that has just completely turned around. There's been a significant bandwagon effect over the last month or so, and people looking at the train pulling out of the station. They look at equity performance moving higher, on this blue line, and they've jumped in wholeheartedly. And that's, this active manager exposure has really contributed to the S&P 500's overall growth. But those dollars can be somewhat volatile, and at the first sign of maybe some softening in the market, you're going to see those that active manager exposure drop a little bit. So I think this chart really sums up, was probably the most crowded trade in the market right now. It's this whole theory that we're going to have, up to 6 rate decreases in 2024. And I think that's honestly getting ahead of the game a little bit. Now the Fed is kind of indicated by their dot plots that they believe that there's probably maybe 3 out there, but I think they've been completely flummoxed over this whole interpretation of the market that we're going to have a lot more than this. And so this chart shows you that that the market really expects a ton of rate decreases and that you're going to have a significant drop in bond yields. And that may very well turn out to be the case, but that's just a really, really, really crowded trade right now. So as we kind of reflect on the gyrations of the market this year, heading into the end of the year in 2024, it's really pretty interesting to note that you're looking at a chart here of the 10-year yield, that we are remarkably close to where we started the year. Now, it's been a journey, as you can see here. In fact, we touched 5%, and we've had this magnificent rally that has taken these yields all the way down to 3.8%, which is a move. It's a volatility that rivals just about anything that we've ever seen in the equity markets. But oddly enough, with all of these gyrations, we're about where we started the year. Comment on gold here. We've had an acceleration in real rates, as you can see here in the pink line down below. And with that, we've seen a breakout in gold. In fact, we're trading at all-time highs for gold right now, about $2,100 an ounce. We've touched that point almost in a couple of occasions here over the last couple of years, but with inflation moving down, interest rates remaining relatively sticky, we have much higher real rates, which is really giving a boost to gold. And I do think that that's a theme that's going to continue to some degree during the first half of next year. Well, the last chart I want to show you is this one here, kind of a historical view on stock market cycles. This is data that goes back from 1963. Courtesy of Visual Capitalists, they do some great work for those who are visual learners. So you can see here very clearly, when you break out bull markets versus bear markets, that bull markets tend to be a lot longer, a lot stronger, and are more prevalent than our bear markets. Now, bear markets do happen, often at a time not of our choosing, usually by virtue of some type of a catalyst, whether it's a policy error or some type of, maybe geopolitical type event. And we've seen that. We've seen, the global financial crisis was born out of a lot of kind of like very aggressive accounting and very lax credit standards and things like that. We had an unraveling of confidence in the whole system back then. Obviously, we had a pandemic that was led by something completely else, completely different. And then we had a fairly significant downturn last year. And if you have relatively short horizons, you can be caught up in these bear markets. And it is very visceral. It's very painful when you're in the midst of that and you're in the midst of a relatively strong drawdown. But, as you can see here on this chart, the average duration of a bear market, it's only about 11 months. The average duration of a bull market is about 51 months. So that's about a little bit more than 4 years. And we always like to say that, that cycles come in like 4 to 5 year segments, not usually, you can't, set your watch by that. But you can see here clearly the power of appropriate diversification, particularly, heading into one of these bear markets. But the persistency of long-term investing and not being emotional, not trying to overthink the market and just take what it gives you is a real virtue in this market. Now, I'm planning on using this slide a lot as we head into 2024 as a visual aid for our clients to kind of help them be a little bit more comfortable with the long term, that there are pockets of volatility, but then there are also notable periods of upside in the market. And so this is the value and the virtue of long-term investing for those who can be unemotional about it. Well, that will end our chart pack this week. I hope you have a wonderful, safe, and happy new year, and look forward to seeing you again in 2024.